lineage coin, so it's something that came from the U.S. Mint. Let's see, we have smallest denomination, U.S. Mint lineage, and it's totally readily recognizable. I mean, if you try to barter with say a 1 ounce buffalo or a bar or something like that, there's always going to be a question, is that real? But if you got a 1964 or earlier dime, quarter, half dollar, Americans know what they look like. And if the date is 64 or earlier, you know for a fact, that's proof, it's authentication, that it's 90% silver. In a smaller way, the Shanghai premium is much smaller. Understand that gold has been mined for thousands of years, and pretty much all the gold that was mined is still above ground. It's either in storage form or it's jewelry. It doesn't get used like silver. Silver, when they pull an ounce of silver out of the ground, how many different uses are there for that? You've got solar, you've got medicinal, you have technological, you have jewelry, you have just investors buying it. The silver that has been produced over the last few thousand years largely has already been used. There's not any big stockpiles, whereas gold, there are some very, very large stockpiles, and I think larger stockpiles than are being let on. I think Russia and China both have well more gold than what they're letting on, and I think the U.S. has far less gold than we say. It certainly looks like it will. I mean, what they've talked about in the past, they've held pretty much to the timeline. We don't have a timeline for a final release, but the weaker the U.S. gets, the easier it will be. The easier it'll be to bring that currency forward. And day after day after day, the U.S. is getting weaker because, I mean, we're paying we'll pay probably 1.5 trillion in interest this year, and add an additional at least $2 trillion to the debt pile. And I guess you could say debt weakens knees. If we were to cover the outstanding debt with the gold that we say we have, you're talking close to $150,000 an ounce. That's where the price would have to go. But that's assuming we have 8,300 tons. And I personally assume that we do not have 8,300 tons, and that gold has been going out the back door for years and years and years. 1956 was the last year there was an audit.
Precious metals are ultimately about trust. Gold and silver are not promises. They are assets without counterparty risk. Fiat currencies, by contrast, depend entirely on confidence in governments and debt markets. Today, that confidence is under strain. Massive deficits, soaring interest costs, and growing leverage weaken trust in paper systems. If a nation attempted to back its debt with declared gold reserves, prices would need to be exponentially higher, assuming those reserves even exist. With no comprehensive audit for decades, questions linger. When trust erodes, markets don't fail quietly. They fracture suddenly, sending shockwaves far beyond metals into credit, bonds, and currencies.
It's not just precious metals. You're talking about trust. Gold is money. It's the only currency, gold and silver, the only currencies that you can trust. Everything else is freely printed. Everything else is fiat. So the shockwaves will be one of trust, and the shockwaves are not going to be held just to the precious metals markets. If silver fails to deliver, and I fully expect silver to fail to deliver in both New York and in London, but when it fails to deliver, that is going to affect all other derivatives because everything runs on trust, and it will probably create much, much higher interest rates in the U.S. because borrowing is done based on trust, and if trust is collapsing, then we'll finally have a risk premium for owning U.S. paper. Let's see what happens over the next 30, 60, 90 days. Because what's happening...
You think it could be that close?
Yeah, absolutely. What's happening, and this has been happening now for the last couple years, is that it used to be that, say, 100 contracts were standing for delivery on first notice day. but by the end of the month, it'd be down to 10. Now we have 100 contracts standing for delivery the first day, and by the end of the month, it's 200 or 300. So the buyers are coming in during the month and saying, okay, I'm buying the contract, I want the metal. All it would take is one big buyer or a consortium of big buyers to come in and say, I want my metal, and it's completely game over because the metal does not exist to deliver.
Incredibly interesting to hear how tight that market is. And, talking about those players that have stepped up and really are starting to take physical delivery, do you have any insight on who those players might actually be?
I think you're seeing a lot of family offices do that. It's big money. For years we saw the retail market in the United States was a big buyer. The retail market is nothing now. The retail market is not even a tailwind. This is institutional money. I mean, these are hedge funds. These are private family offices. And in some cases, sovereigns. Look at Russia. They declared they declared silver a strategic metal, and they're buying it. Look at the imports into India. And those are official purchases.
What's changing now is behavior on the futures exchanges. In the past, many contracts stood for delivery early, then disappeared by month's end. Today, the opposite is happening. More buyers are demanding physical metal as the month progresses. That trend is accelerating. It would only take one major institution or a coordinated group to insist on large-scale delivery to expose a shortage. If silver cannot be delivered in New York or London, confidence in the entire derivatives complex could unravel. Futures markets rely on belief, not metal. When belief breaks, prices reprice violently, not gradually.
You could look at it from both sides. There's obviously reasons for buyers to lie. I bought more than I bought, or I bought less than I bought. It's hard to know, but the bottom line is we're seeing massive demand. We're watching inventories deplete, and at some point in time, there is a tipping point, and that tipping point will be a failure to deliver. It's a game changer, but how long can they do it? Where the supply is going to come from? The supply is not there. The way to fix this is to raise the price massively to entice some people that have bought to sell, because right now, anybody who bought physical metal has not been a seller. I guarantee you there was no big tranches of silver or gold that were sold yesterday. Physical metal. That was all paper. And actually, you can see it's all paper because the Federal Reserve lent, $17 billion on Thursday night, and then they lent another, 35 billion over the weekend to the banking system. And where would the stress have been? It would have been in silver and gold. Look at the price of silver on Friday. It was up, $758, something like that. So those shorts had margin calls. The Fed helped them meet the margin calls and gave them enough to pile more paper on. The only problem is they can't print silver. They can't print contracts that have silver attached to them to deliver. They can sell contracts all they want and depress the paper price, but that is not going to satisfy silver, which is actually used.
This is no longer a retail-driven market. Individual buyers have been replaced by serious capital, hedge funds, family offices, sovereign entities, and industrial players. Countries like Russia have classified silver as strategic, while India's imports continue to surge. These buyers are not speculators. They want physical supply. Meanwhile, inventories are visibly declining. At the same time, central bank liquidity injections are quietly supporting institutions caught short in paper markets. That may stabilize prices temporarily, but it doesn't create silver. Contracts can be printed, metal cannot. This widening gap between paper supply and physical demand is the market's central tension.
Yeah, for a good part of the year, I took more sell orders this year, 2025, than I had cumulatively from 2010 to 2024. So there was a ton of selling. And I did query pretty much all of my people that were selling, and I asked them why. And the vast majority, probably 75, 80% of them said, I need the money. I need the money to live on. I got bills. I got this. I got that. You had some people wanting to buy real estate or buy other things. Uh, Now, what's happened in the last, call it 2, 3, 4 weeks, is that's turned. Retail is now buying. The one sector that is still under heavy pressure is junk silver. And the reason being, back in the 1970s and 1980s, the only way for an American to buy silver really was buying junk pre-1965 dimes, quarters, and half dollars. Now, those people sat on losses for 40, 50 years, and a lot of that metal has come back. I mean, there's a ton of sellers, and what's happened is dealers, because they were getting flooded with metal, they backed away price-wise, and as they backed away and made the discount larger and larger, then that metal was going to refineries to be refined into 99.9 silver, and they pocket the profit. But that's the pressure in the retail market, is selling of junk silver, which is a great opportunity if you're looking to buy silver. Junk silver is now the cheapest form that you can buy, and hands down, it is the best form for an American to own. It's the smallest denomination, which will be best for barter. It can't be counterfeited because they can't be shiny coins. These are in people's pockets. They've got to be scruffy. It's U.S. Mint lineage coin, so it's something that came from the U.S. Mint. Let's see, we have smallest denomination, U.S. Mint lineage. And it's totally readily recognizable. I mean, if you try to barter with say a 1 ounce buffalo or a bar or something like that, there's always going to be a question: is that real? But if you got a 1964 or earlier dime, quarter, half dollar, Americans know what they look like. And if the date is 64 or earlier, you know for a fact, that's proof, it's authentication, that it's 90% silver.
Ironically, retail selling dominated much of the past year, largely driven by financial stress rather than bearish conviction. Many long-term holders sold simply to cover living costs. That selling pressure hit junk silver hardest. Pre-1965 U.S. coins once bought decades ago. As dealers widened discounts, much of that metal was refined and removed from circulation. Today, that same junk silver represents one of the best buying opportunities. It's recognizable, divisible, historically trusted, difficult to counterfeit, and deeply familiar to Americans. In times of disruption, practicality matters, and small denomination silver excels where larger bars and coins may not.
I see no way that we're closing in on a top, because the uses for silver are expanding. The supply is not expanding. We're already in a structural deficit. Both gold and silver. Let's talk about leverage for a second. The carry trade was used to support financial markets for 30 plus 40 years. Leveraged capital has been used to support the equity and the debt markets. And it's also been used to suppress the gold and silver markets. So when credit breaks and there's margin calls, the margin calls on stocks and bonds will force selling, whereas the margin calls on gold and silver will force buying. It'll force buying from the cappers, the JP Morgans, the Bank Americas, the companies that are short and have been short silver. Their way to exit the trade is to buy, and that will create massive upside pressure on the metals. No, it's not too late, because when the fiat currencies truly break and zero out, gold and silver will be the absolute core of whatever comes forth after that. So no, we're still early. We're early in the game price-wise. Time-wise, I don't know, because we could have a failure to deliver this month, next month, whatever. When it fails to deliver, then it's game on, or it's game over, actually. So you'll see the price of silver, the price of gold go to where it should, unfettered by derivatives, unfettered by futures contracts that are naked, have no gold, no silver behind them, but they're sold. The last part of your question, um, if I had nothing at all, I would start with silver because, yeah, it's nice to hold a 1 ounce gold coin in your hand, but it's also probably nicer to hold 60 ounces of silver that you're going to be able to use when a system breakdown comes. You're going to be able to use silver. Farmers understand silver.
Silver's uses continue to expand while supply struggles to keep pace. The market is already in structural deficit. Add leverage, derivatives, and short positions, and the pressure builds further. In financial crises, margin calls force selling in stocks and bonds, but force buying in metals. Short sellers must eventually close positions by purchasing real metal. When fiat systems strain or fail, precious metals don't disappear. They re-emerge as foundations. Timing is uncertain, but direction is not. Whether through delivery failure or loss of trust, silver's price will eventually reflect reality, not paper promises. In that sense, this story is still just beginning.